The S&P 500 average price-to-earnings ratio is 20 times. Many high-growth tech stocks trade above 50 or even 100 times. Traditional price-to-earnings measures current profitability against the stock price. This metric is fundamentally distorted for high-growth companies. They prioritize massive market share expansion over immediate net income. High research and development spending immediately reduces GAAP earnings. Aggressive hiring also inflates the price-to-earnings denominator artificially. This metric fails to capture the immense value of future revenue streams. These streams are being built aggressively today. The market prices in expected exponential growth rates. It does not price in current static performance figures. Investors must look beyond simple price-to-earnings ratios. Relying solely on price-to-earnings leads to massive valuation errors. We need better tools for modern tech analysis. A high price-to-earnings ratio signals market expectation of extreme future earnings growth. This does not necessarily indicate current overvaluation. Assume a company grows earnings by 50% annually. A current price-to-earnings of 50 times means the forward price-to-earnings is 33 times next year. This assumes the stock price remains constant. Investors willingly pay a premium for compounding growth rates. These rates must consistently exceed 20%. The price-to-earnings ratio becomes irrelevant when a company is pre-profitability. It is also irrelevant when margins are near zero due to mandated reinvestment. Valuation must account for the time horizon. This horizon ends when scale economies are finally achieved. High price-to-earnings is the cost of buying future dominance today. The price-earnings-to-growth ratio standardizes valuation analysis. It divides the price-to-earnings ratio by the expected annual earnings growth rate. The growth rate is always expressed as a percentage. A PEG ratio of 1.0 suggests the stock is fairly valued. This valuation is relative to its specific growth potential. Tech stocks are often considered cheap if their PEG is significantly below 1.0. This indicates that growth is outpacing the valuation multiple. The PEG metric is superior to simple price-to-earnings. It directly accounts for the velocity of earnings expansion. PEG is most reliable when company earnings are positive and predictable. It helps compare companies with vastly different growth profiles. Use PEG to identify growth stocks trading at a discount. Price to sales is the primary metric when a company has negative earnings. It is also used when net income is highly volatile. Price to sales measures the market capitalization against total annual revenue. A price-to-sales ratio of 10 times means investors pay $10 for every $1 of sales. This ratio is most useful for software-as-a-service companies. Their revenue is typically recurring and highly predictable. High customer acquisition costs often suppress current profits. Price-to-sales ignores these temporary profit suppressions. Comparing price-to-sales across similar industry segments is essential. Look at cloud infrastructure or cybersecurity peers for context. This comparison provides essential context for relative valuation. High revenue growth justifies a higher price-to-sales multiple. Free cash flow measures the actual cash generated by the business. This is calculated after accounting for necessary capital expenditures. Free cash flow is less susceptible to accounting manipulation than reported net income. Free cash flow yield is calculated by dividing FCF by the market capitalization. This yield indicates the actual cash return on your investment. Mature tech companies like Microsoft or Apple are increasingly valued on FCF yield. Investors typically target a yield between 4% and 7%. Negative free cash flow is common for hypergrowth firms. However, sustained negative FCF is a major red flag. If revenue growth does not correspond, it signals significant operational risk. It also points toward potential insolvency issues. Focus on cash generation, not just reported profits. Stock-based compensation is a significant non-cash expense. It severely depresses GAAP net income figures. This is especially true in high-growth tech firms. They use it to compete fiercely for engineering talent. Stock-based compensation is dilutive to existing shareholders over time. Management often excludes it from non-GAAP earnings metrics. Investors must add back stock-based compensation to net income. This is necessary when calculating true free cash flow. Alternatively, adjust the share count for the resulting dilution. This helps understand the company's true cost structure. High stock-based compensation relative to revenue is a major red flag. If it exceeds 15%, valuation sustainability is questionable. It represents a continuous transfer of value from shareholders to employees. High valuations are justified by the time value of money. They rely on the expectation of massive future cash flows. The discounted cash flow model calculates the present value of all expected future free cash flow. This value is discounted by the company's cost of capital. Tech valuations often rely heavily on the terminal value component. Terminal value assumes perpetual growth after the high growth phase ends. This phase typically lasts 5 to 10 years. Small changes in the assumed long-term growth rate drastically alter the current valuation. Higher interest rates increase the discount rate used in the model. This increase reduces the present value of distant cash flow significantly. DCF modeling requires careful, conservative assumptions. Price-to-earnings ratios regain relevance when a growth stock matures. This happens when the company becomes a stable, profitable entity. This transition occurs when market saturation limits hypergrowth. Typically, revenue growth drops below 15 to 20% annually. At this stage, the company shifts focus entirely. The focus moves from market share acquisition to margin expansion. They prioritize shareholder returns like buybacks or dividends. Investors then apply traditional price-to-earnings multiples. These multiples are typically 15 to 25 times earnings. They are based on industry averages and macroeconomic stability. Ignoring price-to-earnings for mature tech companies is a fundamental valuation error. These companies have ceased aggressive reinvestment strategies.